Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program.
G'day, welcome to the Australian Property Podcast. This is our weekly 2 cent segment. I'm your host, Pete Wargent. I'm here as I am most weeks with Chris Bates. Chris, how's it going?
Pete, always good to chat. Happy Sunday to everyone.
Yes, happy weekend, and thanks for joining us today. So this is our weekly 2 cent segment where we take a plain English look at the big 3 property news stories of the week. Before we run through those, Chris, how's your week been?
Oh, it's been good actually. I'm finally getting out of the sickness, I think, but didn't do too much on the weekend. Just lots of play dates actually with my daughter. So she's 3, and just catching up with her friends from kindy. It's quite cute, and they really want to see all their friends on the weekend. So it's that's dad life for me. What about yourself, Pete? Ashes. Even though it's Sunday, the test will be over, but we're recording this on Tuesday this week, and big final day in the first test. So what's your bet? England going to win it, or Aussie's going to?
Yeah, I can barely watch. It's yes, we're recording this just before the final day, so I've got at this point no idea. It could go either way. It's right in the balance, and there's so many Aussies over in England at the moment as well. So rubbing our noses in it if we lose. So, but by the time this goes to air, the result will all be known, and we'll be talking about next week's test match. So, but yeah, it's been a beautiful summer so far. So. Yes, fingers crossed for a good result. So the big 3 property news stories this week. So firstly, there was some whole new figures out on Australia's population growth and population trends, and actually bigger, faster, stronger than expected. So population growth was very strong last year, but also the actual population clock was revised up, which wasn't really much picked up in the media. So we'll talk about that. Booming jobs figures, even still, the last month of figures for jobs just powering along. So we'll have a look at that. But also there's a kind of a tug of war going on because that fixed rate cliff is now starting to bite and pull in the other direction. And loads of retailers are reporting a downturn in trading conditions. So we'll take a look at what all that means. And then thirdly, slightly different story from Henley Global on millionaire migration. Australia now the number 1 country destination for high net worth individuals in 2023. There's a bit of a lull through COVID where nobody was going anywhere, and now it's come rocketing back. So we'll take a look at that too. So how does that sound, Chris? Should we kick off with a population story?
Yeah, absolutely. I think there's some interesting stories that we will cover next week around. There's a real battle with in the government right now with the pressure to bypass local and state governments. Well, the state government's basically forcing developments down and giving developers the power. So we'll talk about that one next week because it's going to come out a lot over the next week. But the population boom. I mean, if you go back just a few years into COVID, I would. It was hard when obviously population was falling off a cliff. You had a lot of people saying, hey, population's falling, property prices are going to fall. There was that sort of people do that level 1 thinking, I guess I call it, where they try to simplify it that simple. Population going down, property prices must be falling. But ultimately, there was always going to be a bounce back in population. And I guess it's been much stronger than people expected, Pete, and is really surprising how fast it's bounced back. Is that sort of your take?
I think, yes. If you look at financial markets, it's rarely as simple as A happens and therefore B is the outcome. And certainly in the property markets, that was the case. Yes, the international borders were shut for a period of time, but I don't think anybody in the market was thinking that this would be a long-term thing. At some point, population growth was going to come back, and we've always had very big population growth in Sydney, Melbourne, Brisbane. And I think a lot of people just took the opportunity to buy when there was less competition. And as you said, the population growth having gone to near enough zero for immigration, well, the 2022 figures are now finalised. Population growth was near enough 500,000. You can sort of round it down with a bit of change there. So 500,000 people over the calendar year, that's the highest we've seen. And interestingly, if you look at the population projection, so the ABS runs a population clock, and it's based around number of births, number of deaths, an expectation for the numbers of people entering the country, leaving the country. Anyway, the current pace of population growth, one extra person every 47 seconds. Now, if you project that out, that would equate to population growth of, even higher this year, about 670,000 people. I don't know that it would be sustained through the whole year. And anyway, these numbers are estimates. But in any event, the population clock has been revised up by about 50,000 or so to 580,000. So it was only just a couple of weeks ago we went through 26.5 million. So basically, there's more people than we thought in Australia's resident population, and it's actually growing now faster than we thought as well. So I think the first thing that jumps out to me, Chris, is we literally cannot build enough housing for that rate of population growth for as long as it's sustained. I think we tend to approve and then actually commence and complete. The numbers usually wrap up at about 40,000 per quarter. But if you're getting 500,000 people into the country, it's just nowhere near enough housing supply. And that's even before you account for demolitions, which probably takes 10% off those numbers. So obviously this is going to result in sort of a bunching up, and the Reserve Bank is expecting people to economise on the use of housing stock. So more flatmates, more people staying home for longer with parents. We're seeing really major issues in some of the rental markets, notably Melbourne. It's I guess we knew population growth was high, but it's actually even higher than we thought now.
Yeah, and I guess we can see that in the issues in the rental market. And that's, I guess, my first point where, people think the property prices are going to down because there's no migration. Well, they don't just straight away buy property. They, you don't just move to a country and buy the next day. You sort of get into the community. You figure out exactly where you want to live. You get a stable job. You might have to save. A lot of them are students. A lot of people, just trying to it's just not impossible, right? There's usually a lag, and maybe it's, 3 to 7 years, depending on the person. And maybe there was no migration 2020, 2021, for example. So maybe that's future housing demand that, we didn't get. But I guess it's going to bounce back in a few more years. I think that there's a real issue at the moment because I think builds and project approvals are down massively. And we've spoken about that before, all the way back to 2009. And I think they're 25% down on where they, were. And I guess I get the thought of Gladys just a few years ago, pre-COVID, we need to slow down migration. Our infrastructure can't keep up. Then COVID happened. So that did give them a chance to keep. But I think we're already brewing another problem here where we just can't build enough housing. So we're going to get debt stress, but we're also going to get some people are going to be forced to, obviously people try to solve the debt cycle with the renting cycle by buying, but unfortunately not everyone's going to be the one that wins those purchasing competitions. So I think you've also seen a lot of people, Ray White have done a lot of articles around the number of bidders at open homes is really increasing, the number of inquiry, etc. And so, if someone wins an auction, there's usually 4 or 5 people who don't win it, and maybe they don't buy. And I think that's an issue that we can see building. And it probably might make sense, Pete, to move to the third story rather than the second story here, where I guess the millionaire migration to Australia is also really high for Australia. Should we go there before we go to the unemployment market?
It's a related story on population and migration. I just wonder, taking a contrarian view, Chris, and this was something that a couple of people have been bouncing around on socials, is if you look at the federal budget, population forecasts out for 5 years, we're looking at over 2 million extra people in Australia. And of course, with the caveat that things can change. We saw border closures through the pandemic. So these numbers could obviously be subject to change, but it's clearly going to be a very high population growth period over the next 5 years. And there's headlines all over the place. Construction industry is doomed, insolvencies spiraling. But I wonder whether now, if you look at what stock markets have been pricing, a lot of those developers have really been marked down over recent years, in some cases since 2008, actually. But presumably for the companies with stronger balance sheets, it's actually going to be a much better 5 years ahead. Some of these smaller companies will go into administration or insolvency if they don't have strong balance sheets. But actually the demand for housing, the demand for hotel accommodation, the demand for public infrastructure is all going to be massive over the next 5 years. And I suppose that for those businesses with deeper pockets, capital management through the cycles, it might actually be, well, a better time ahead, I suppose, just based on the sheer weight of demand from population growth.
Yeah, I would say so, but I'd also say that there's a real issues for borrowers right now. Borrowers can only, if you're thinking about even apartments or new house and land packages or new townhouses, for example, the borrowing capacity of, the first home buyers, 4.5 times income. Whereas, it was maybe 6.5, 7 times income. It's gone down so much. And so even a couple that's earning, 200, 150, 200 grand a year, they might not have enough borrowing capacity to buy that house or that's the house and land package or the townhouse or the apartment. I think borrowing capacity is a real issue. And I think there's a little bit of pressure from the developers to, get into APRA's ear and start to relax borrowing capacity because, that's a real concern. If people can't borrow the money, then they can't sell them, even though they want to buy them. And so developers in that situation will land bank and they'll release the lots because it's not profitable to release it now. They'll release it in a few years' time when there's even more demand built up, pent up demand, and borrowing capacity comes back. So I would say that's one client who we're dealing with at the moment. They've got they bought a block of land out in the western northwest parts of Sydney, and they bought it for 720 at the height of the boom, and it's worth 570 right now, just the land. This isn't a building on it. And, we got a valuation on it. We didn't help the client buy this land. We're not a fan of this type of investing. They've come to us after the purchase on figuring out options to get out of it. And it's a real tough one that, they've potentially, if they want to get out of the contract, if they do that, the person who's got the contract's saying they're going to sue them because it wasn't through a developer, this situation. It was actually through someone who had already bought it off the developer. So it was like a private transaction rather than straight off a developer. And it's a really messy situation. It's probably only worth 570 to 600, this land. They're paid 720. They've actually negotiated a cheaper price, which has been amazing, but they're still massively underwater. And I think this is one of the issues in that space is there's no lack of demand, but maybe there's a lack of borrowing capacity to actually to buy this. And so, I think we're talking to I've got a big development client that I help all the staff out with their and I was just chatting to one of the heads there last week, and they were really talking about the challenges and some losses on jobs and the ability to hire staff. And once you've sort of gone hard at it, it takes a while to build up the kitty to go again. And so I would say that a lot of developers are a little bit gun shy as well, maybe, to go full throttle because they've been burnt in the last cycle a little bit and they've got less buffer to play with. And so I would say that maybe is an issue for some of these guys as well, Pete, even if they do want to go hard and take advantage of maybe some other developers not doing so well. Have they got the resources? Have they got the staff? Have they got the guts to go for it again after they've potentially been burnt?
It's difficult. I mean, a lot of people have found that they can earn more money in mining and resources where construction's picked up again. So it's hard to get the staff at a good cost. The cost of actual building and delivering medium and higher density stock, well, that's probably up 50% from a few years ago. So that's one of the reasons I have been somewhat bullish on the price of established units, because who's going to build at the moment until prices take a 25% leap? I think there's just a pressure cooker building up. But as you said, some of these greenfield estates, house and land packages, we've seen so many issues over the years, people getting themselves into trouble. There's just so many more moving parts. And actually on that point, Amy Lunardi and I have an episode coming up on house and land packages and the pros and cons of going down that route. So keep an eye out over the next week or two. We'll do a full deep dive on that very subject. So so I got sidetracked there. Millionaire migration. So Henley Global puts out an annual report on this. So they basically track real-time data of where the global high net worth individuals are migrating to and where they're migrating from. So they track the data via a group called New World Wealth. So there was, just like in everything else, there was basically no high net worth migration through 2020, 2021. But for 2023, we're expecting to see record high net worth migration. So like a lot of these, or so many of these graphs and charts, we've seen stuff drop off a cliff, and now it's come rocketing back as all these people are actually able to move again. Russia has been a major country for departures in recent times due to the geopolitical challenges there. But for 2023, wealth is being driven out of particularly China and India. I think that's largely just by virtue of being the largest countries. I guess a combined population of 3 billion. There's a lot of millionaires moving. But interestingly, Australia now number one on the list in terms of destinations for the global elite. So Ray White did a little summary piece, Nerida Conisbee. So if you could live anywhere in the world, where would it be? For the world's wealthy, Australia is the top pick. And this year, we're set to attract more wealthy migrants than anywhere else in the world, according to Henley and Partners. An advisory to the world's highest net worth citizens, 122,000 US dollar millionaires are expected to migrate in 2023 globally, with Australia number one on the list, with over 5,000 high net worth individuals, Chris. So I thought this was pretty interesting. Usually in the past, it's been the tax haven countries have always featured high on these lists, the UAE and places like that, for obvious reasons. People are looking for places tax efficiency, but Australia is obviously seen to be a safe and secure pick. And Ray White did some analysis on the highest capital growth suburbs for housing over the past 12 months. New Farm in Brisbane has seen the biggest jump of its median. Queensland is on track to see more international migrants arriving than ever before. But some of the regional suburbs a bit more mixed. So what was your take on the whole Henley report, Chris?
So I think the high net worth in there, Henley's version is $1 million US. Let's just call that 1.5.
I think it's $1 million US investable. So yes, it's not just net worth. I mean, yes, you could certainly take the argument that I think a high net worth individual these days is really 5 million US. Things have moved on since they started doing these reports years ago, when $1 million was considered to be the holy grail. So I would agree that's definitely a factor.
Yeah, so I think it's not those super wealthy. You can see the top end market of the capital cities is going gangbusters. It's not really affected by higher rates. I mean, there's a lot of articles saying that people over 3 to 4 million property purchase, that's what they see as high end. I'd probably say it's a little bit higher than that, to be honest. I still think a lot of people in that 3 to 5 are taking on decent sized mortgages. They're not at that next level where they're, cash buyers, which there's been a bit of talk around as well. But I think that you made a really good point around established apartments, Pete, which I'd sort of like to double down on. We're absolutely seeing that. A lot of people who are in that sort of the first home buyer stage who would love to potentially get into the housing market. It's just because of borrowing capacity, they can't do it. And it's like they could do it, but they're going to get the C's and D's of the suburb, the smaller houses, the busier roads, the darker places, etc. And they're like, so I really want to buy that, or do I just buy a bigger open apartment that's going to suit us for a smaller runway? And do we knuckle down, even because higher rates, we don't want a bigger mortgage, we want to be a bit more conservative. And do we knuckle down, try to build our income and build our cash, and then try to upgrade in the future? Plus, I think migrants, if you move to Sydney from somewhere else in the world and you're on one of these high net worth, you're probably not just cash rich, you're probably income rich as well. So you're probably doing all right from an income point of view. And you're doing and those higher incomes are usually around the city, right? And so what we find is that people who have moved over here are more the skilled migrants who have, potentially, doing quite well financially. They want to live the Sydney life, right? They don't, for example, want to move regionally. They don't want to move an hour commute. And they're potentially grown up in apartments because of a lot of, countries around the world. That's and for their mind, getting to live in, the most beautiful suburb, but getting a bigger 2-bed is more than suitable, right? That's what they're aspiring to. And so they have a lot of them will absolutely be supporting the established unit market. And a lot of also locals who would love houses are also supporting there. And a lot of people aren't selling out of it because they can't afford to upgrade. They haven't got enough cash and borrowing capacity to upgrade from it. And they don't want to because they're worried about interest rates, etc. So you've got a lack of quality supply, but really strong demand. The first in New South Wales, the $1.5 million no stamp duty was really supporting this market. It's going to be interesting to see what happens from a couple of weeks' time when it moves, when that's not an option. But I would say that demand's still really strong, under that 1.5, and stock's really low. So, yeah, the millionaire story is, I mean, as a number, even though our population is only 26 million, I think we just said, the number is based on a number, not a percentage. And I think that's something that we need as a country, right? That's money coming in that's going to support our economy and, drives job growth. So it's something to be proud of, I guess, that we're in that position.
Certainly is. I mean, it's a great country to live in many respects, and there's good things like education, climate, lifestyle. All these things feed into it. Ray White reported that premium suburbs in capital cities are now leading the recovery in prices, possibly due to the high levels of wealth entering the country. I was chatting to Abul Rizvi, who's an analyst of all things demographics online, particularly visa issuance, and he made a good point that actually a fair chunk of this could actually be high net worth Australians returning to Australia. Because when you drill down on the numbers, Hong Kong was one of the countries suffering an outflow, and there's been some political changes in the landscape in Hong Kong over the past few years. So that would certainly be a factor there. Aussies coming back. Also, the UK, a big net drain out of the United Kingdom. Now, in my experience, the people who come from the UK to Australia, yes, you do get some retirees or pre-retirees, but I would say a lot of these are probably expats returning to Australia and bringing some of their wealth back from overseas. And we often see that. I think people in their career, they go and live in these lower tax jurisdictions sometimes, earn a fair chunk of change, and then bring it back into the country. So that's definitely a factor. I think just going forward, I mean, with the numbers for 2020, 2021, and even to some degree 2022 was so low on millionaire migration. And now we're expecting to see record highs this year, record highs next year. So I think it's going to be more of a factor going forward. And it's, the flows are really, if you look at the countries, Australia number one, UAE, Singapore, those low tax countries, Switzerland features high. And then from the aspirational people, USA and Canada, but Australia a clear number one now, which is, I mean, it's a bit of a tired old cliche about Australia being a lucky country, but it certainly seems to be.
Yeah, absolutely. We've seen, clients that are absolutely taking opportunities around the world. We've always got clients that are moving to places like Singapore is a key one. Got clients moving to Dubai or back to the UK for a couple of years. We definitely see that sort of, that double income, high income young couple that, go to London for 2 years. They usually stay for 4 or 5, to be honest. And then they come back. So yeah, and we're also seeing a lot of people come back from overseas, but they love to buy while they're still over there. With this one last week that I was chatting to, plans to come back in 3 or 4 years from Hong Kong. It's got heaps of properties, doing really well, from an income point of view. But to be honest, there's no way we can get him into the housing market without selling everything, and just because borrowing capacity is just really tight. Plus, it's even tighter for expats unless you go to, certain third tier lenders and non-banks, and you've taken a real risk in terms of rates and rate creep and all sorts of things. So, I mean, it goes into our next story, Pete. I mean, a lot of people moving here, but we've got the jobs, right? Our unemployment, instead of going up, it actually went down, didn't it? So, what's the story there?
I think so the final story this week, it's the jobs versus spending tug of war. So we've got things going in different directions. Now, if you look at the jobs figures for April, I actually made this point before the jobs figures came out. They look very dubious. The jobs figures, despite all these job advertisements we've got, they've been tracking at record highs. Jobs figures went backwards in April, but I think that was a statistical anomaly because of the timing of Easter, which was unusual this year. It was always going to be a rebound in May, which wasn't really being predicted by financial markets. Anyway, jobs growth in May, 75,900, mostly full-time jobs. I think when you get these massive ups and down swings, it makes a lot more sense to take a look at a 3-month average. And it's still running at 47,000 jobs a month, which is very strong. As you said, unemployment rounded back down to 3.6%. So I think that keeps upward pressure on the Reserve Bank and interest rates. But I think if you look at some of the forward-looking indicators, Seek reported job advertisements are now 22% off their highs. But actually, I think if you look at the real sort of canary in the coal mine is retail spending. I think if you look at just even since we spoke a week ago, the amount of outlets and retailers that have been reporting consumer spending dropping off a cliff. ANZ have reported this. David Jones, some of their stores saw like-for-like sales dropping 20, 30%. Retail food groups, so that's the Donut Kings and Gloria Jeans of the world, big crunch in retail conditions. Solomon Lou, Peter Alexander, Smiggle, Just Jeans, kids stuff. I probably can't even think of the others. Target, Cotton On, all over the place. We're seeing retail conditions deteriorating, and actually plenty of instances of price discounting in some of those aforementioned stores. Myer, David Jones having massive stock take sales. Even some supermarkets discounting. So I guess, Chris, the story is jobs growth is still strong for now. I think if you look at the slack in the labour market, though, it is just starting to rise. So underemployment, underutilisation. And I think, as we've touched on in a previous episode, the fixed rate cliff is now biting just since April and May. And a lot of people are going from 2.5% mortgage rates. Suddenly they're on 5.5 or 6. And it's having a massive impact on the retail sector. So I guess, though, this is how inflation comes down in the end, is when retailers start discounting, retail prices come down. I think it's happening. It's probably just going to take some time because we've still got some energy price shocks to flow through. And anyone who's renewed an insurance policy recently would have seen insurance prices have spiked. So I think if you're looking 3, 6, 9 months ahead, I think we can expect to see those inflationary pressures dropping away, but we're not quite out of the woods just yet.
Oh, absolutely. I mentioned, I think last week that we'd had a couple of clients reach out to us where they're really feeling the pinch. That's absolutely jumped up quite a lot in the last week. I think it is that mental number, that 4. I think it's finally said to people is, hey, we need to be worried about this. And the forward guidance has been quite negative as well in terms of more rate hikes. And I do think people are really worried about their repayments. They're coming off the fixed rate cliff. I think that's still got a lot of legs to go in terms of, a lot of people are still fixed to 2024. But I think they're planning now. They're really saying, hang on a sec. I know that, there was one client, quite a big loan actually. And, it was a real discussion around, what do we do next year? There's actually 2 clients I can think of in the last week where we had details. How do they get prepared for 2024? So they're not even off the cliff, but they're already making cutbacks. And I think people need to, not like people aren't smart to not be doing that forward thinking. I think people have been doing that all the way through, but I think people are realizing now that rates are higher than they thought they were going to be coming out of this cliff. And it makes sense to cut back on retail straight away. And so, this is probably not a bad thing. It's not great for retailers, right? But it's probably not a bad thing for and people who work in retail. But it's not a bad thing for trying to get on top of this inflation genie and put it back in the bottle. And if that happens, then there'll be relief in terms of home loan rates and really hitting our sort of younger generation who's really taking the pinch here. The older generation are loving it, right? Like if you're paid off your home and you've got a lot of money in cash and the stock market's doing pretty well, reasonably, right? And your super returns aren't falling off a cliff and your house prices is quite supported. Well, what are you worried about, right? You'd be out spending because your cash is getting, 5+%. So, I really feel for the people who are, not, wanting to take on a lot of debt, but ultimately that's their solution to solve their long-term housing need and for their family. And so these are some of the issues that we're dealing with right now.
Some of the data providers and the economists, they're a little bit cagey in recent months, but it was just looking at the ANZ observed spending annual change figures that just came out. So this goes to the period to the 11th of June, and suddenly things are looking really bad for spending in the economy. If you went back to August and September last year, stuff was absolutely booming year on year. Dining, takeaway, shopping, travel. I think travel spend was up nearly 70% over the year because people had been denied the opportunity. We had all this cash that was saved up because people couldn't go on holiday. They weren't buying new vehicles and so on. But I would think grocery shopping figures have held up because people don't really change all that much what they spend on their groceries. But if you look at travel, that's down deeply in negative territory. Shopping, dining, takeaway, it's all falling year on year. So I think there's some really good evidence there that although it took some time for interest rates to bite, now they really are biting as those fixed rate mortgages reset. And that is really how we're going to see inflation come down. Now, a lot of the retail commentary has actually said that stuff has really deteriorated just in the past 2 weeks or so. So this could turn around pretty quickly. And if we're looking for indicators that inflation might actually start to come back down again, we're only sort of now in the second quarter of the year, but maybe by the sort of the fourth quarter of the year, you might start to see things calming down a bit. I still think a lot of people have been posting pictures of their sort of energy bills being renewed at much higher prices. So there's probably still a bit to feed through from there. But certainly in retail, things seem to have turned downwards quite sharply, I guess.
And I think the thing with the property market with all this is that rates are higher and it's less likely to now transact. And property is priced on the marginal buyer. So how many properties are for sale? How many buyers want to buy them? That's what matters, right? It's not a broad-based asset where people are buying and selling all the time, like the stock market, for example, where it's still the marginal buyer, but there's a lot of people who transact a lot more because of the costs, etc. And so I would say in this situation, all we're going to see is a real tightening of supply, not what real estate agents want to hear. And the number one in the country came out last week and apparently and said to Chris Joy that lots of people are rushing to sell. I just don't think that's true, to be honest. I think that a lot of people are thinking potentially to sell if they could sell for a good price. But if they're worried that, they're not going to get a good price, then they're just going to hold, right? People don't just rush and sell their property. So in the next 6 months, there usually is a pickup in spring listings. Yet maybe there is definitely some listings coming on. There's always natural listings coming on, death, divorce, aged care, investors selling, etc. But I don't think you're going to this boom in listings. And so we're going to see really tight listings over the next 6 months, I would say. There will be a drop in demand, but I think there's enough steam behind the market and a lot of people pent up demand that are betting on rate cuts. That while they know that rates are high now and they're going to potentially go higher, they're saying, well, by the time I settle on this property, by the time I move in, I might only need to pay higher rates for 6 to 12 months. I'm happy to take that gamble. And I think they're the ones who are also doing well financially. They're not worried about their jobs and they're competing over a small number of listings. I still think there's pretty much just lemons on the market right now. There's very little quality assets. There's actually been situations where two clients have wanted the same property because it's so low listings. And this is the best property they could find. And they both say, hey, Chris, what do you think of this one? Obviously, I tell them there's another client of mine who's looked at it as well. But that's quite rare. I think that's just so scarce of how many properties are on the market that are quality.
Oh, we've had the same issue. Yeah, trying to find, especially for people who've got a specific brief, if they're looking to be near a certain beach or near a certain school zone, there's very little stock on the market. Everything's very gummed up, and it's difficult, but it's also underpinning the market. Chris, talk to us before we wrap up. You're the mortgages expert. Now, this is a really unusual situation where we're seeing a load of fixed rate mortgages in Australia, which normally most people are on variable, but we saw a big surge in fixed rate borrowing through the pandemic, which made sense. It was very, very cheap to do so. But now we're resetting to much higher rates. And I'm sure the pessimists of the world would say, well, I've seen this movie before. This is what happened with subprime lending. Mortgages were written here and then they reset there. Now, obviously, we're going to see a rise in mortgage arrears because they're at record lows. But what is going to happen? What should you do if you're having challenges meeting the repayments? What should people do in terms of speaking with their lender or speaking with their mortgage broker? And how do you see this playing out? Are we going to see a wave of defaults or a wave of arrears, or do you think there's enough steam in the economy to see us through to the other side?
Oh, I think it's going to be really in pockets, to be honest. I think the high density apartment pocket where people are in negative equity, the banks aren't, they can see there's no real way out in the short term. And, they don't really want to have arrears on their account. I think they'll be encouraging sellers, owners of those properties potentially sell, especially if there's, depending on how negative equity it is, right? Do you want to really encourage someone does a bank take an interest and say, hang on a second, I'm trying to get you through this next 12 months? and take that gamble, or do they sort of say, we don't really want the arrears and we don't want to default, should you really sell? So I do think there's going to be an increase in arrears, but I don't think it's going to be mass market. I think you've really got to, while there's that story, it's going to be coming up in certain pockets. Our good friend Martin North, who, the perma bear in the property market, I'm happy to call him that, does rental stress and mortgage unaffordability metrics, and it's usually in certain pockets where it's much higher than other pockets. And I think the newer housing estates over the last few years, that story I spoke about before, is going to be one of those pockets. Across all our country, to be honest. It's not just in our capital cities. It can be in the regions, etc. But yeah, it's not going to be this. I do think, though, that we will get through it. I think there'll be this peak in rates, then there'll be this time when rates are now coming back down. That's what everyone's forecasting, right? Like, it's unsustainable. Assuming we win the inflation war in a reasonable time frame, it doesn't stay, 3 or 4 years' time, there's going to be rate cuts. And in that environment, both the owner of the property plus the bank will be like, hey, how can we get you? Because we know rates are going to start dropping. How can we just get you through the next 6 months? What can you do with your employment? And I think that's what we're going to do. It's just building that bridge. I guess with COVID, there was those payment holidays. Maybe it's not payment holidays. Maybe it's, payment, half payments, or maybe it's just a pause, or maybe it's extending terms or interest only, or, something like that. Not this mass market payment holidays, but I think everyone's incentivized to try to get people through this period. And I think APRA is going to be supporting the banks to give them a bit more leeway than they usually would in a hot market where, they don't really want banks to be letting people off as easily.
I think 3.6% unemployment obviously helps. And
absolutely,
I think as well, the previous cycle, there was a lot of apartments where people were really struggling to find a tenant because there was an overbuild in certain areas and people had overpaid for new apartments. And so, well, that's not really the case at the moment. Certainly markets like Sydney, Melbourne, Brisbane, there's a lot of tenants and not many vacancies. So there's a couple of things that will help to keep a lid on arrears. But there's no doubt, I would say, over the next 6 months, we'll be reading more stories about mortgage arrears rising. It's inevitable because they've been at record lows, but I guess we've never seen such a sharp increase in interest rates. So yes, if you're not sure, get in touch with Chris or your friendly mortgage broker and have a chat about what you should be doing to prepare for that period ahead. So Chris, let's wrap up the big 3 stories this week. So population growth stronger than expected, 500,000 people in Australia last year, an increase to the estimated resident population. Population clock has been revised up by about 50,000, and actually population growth even faster in 2023. And I wonder whether this might become a political issue over the year ahead with housing shortages, people complaining about pressures on infrastructure, housing, and other matters. Secondly, the booming jobs market, which we actually covered as the third story in the end. But yes, even now, up until May 2023, jobs growth just firing along. But we're definitely seeing now consumer spending is dropping really sharply. And I think we're just starting to see now the retailers are starting to discount their prices. And that, in the end, is how inflation will come down. I think retailers have had the upper hand over the past couple of years, all the stimulus payments, and people haven't been traveling overseas. But now that's starting to flip the other way. And we might start to see some end of financial year stock take sales and price discounting around the traps. And thirdly, Australia is now the number 1 destination in the world for high net worth individuals, with record high global millionaire migration expected for 2023, 2024 and beyond. So that will have an impact in terms of money coming into the country. So I think that's it for this week. Thanks so much, everyone, for tuning in. Now, do send us your questions if there's anything you would like us to cover. We'd like to be guided by you. And if you want to catch me, my daily blog is Pete Wargent Blogspot, or I'm on social media on Twitter at Pete Wargent, although I might deactivate my account if England lose the cricket. So stay posted. You can always subscribe for the Rask podcast, of course, on your favourite podcast player and also on YouTube. And Chris, if people want to get in contact with you at Blusk, if they've got mortgage-related questions or general life advice, where should they go to for more?
Yeah, the life advice, I'm not sure about that one, Pete, but absolutely the mortgages. Check the link in the show notes, fill that type form in. It doesn't take very long, and then book book a time in the calendar with our team, and we'll just have a chat. There's we've been helping, lots and lots of people, not just through the podcast, but through Rask for years. And we'd really love to help give you that clarity at the moment. I think that's what people really need, whether it's you've got a mortgage or you're thinking about taking on a mortgage, that clarity is, sometimes surprises you, or sometimes it's still not great news, but we'll try to do whatever we can to give you a plan B. So, great to chat, Pete. Happy Sunday to everyone. Past winter salsa, which I'm looking forward to, because this sickness is hopefully next time we're recording, I don't sound like sick. So that's my goal for the next week. So
if we keep saying it long enough, eventually it'll come good. So
exactly.
Thanks, Chris, for soldiering through, and we'll see you next week. Cheers, everyone.
Cheers. Thanks, Pete. Bye.